Hi, everybody. I'm back with Kelly Augspuger. She's a certified senior advisor and long-term care insurance specialist who co-founded Steadfast Insurance with her husband. And without further ado, let's get into this. Let's segue into the specifics of long-term care insurance. We have three things that I have noted that we had talked about, which is the importance of assessing needs, what they need to do financially, and what does a plan consist of. So
Okay.
I'll let you run with that.
Yeah. So to kick it off, let's really define what does a long-term care insurance policy do? What's the importance? Well, we talked about it's a way to financially protect you, right? It's also a way to protect your family, being able to hire professionals so that your caregivers, your informal caregivers, typically your family, doesn't have to provide that care. The long-term care insurance is going to provide leverage, right? Think again about your home and auto. You pay those monthly annual premiums. You're getting a big pool of money for protection. Same thing with long-term care insurance, okay? You're putting in these premium dollars for a bigger pool of money for protection. Alongside long-term care insurance policies, as well as that leverage that you're getting, typically you have these other benefits too that I don't think most people even know or consider. These are going to be things like care coordination. Most policies have some level of care coordination. What does that mean? This is an advocate, this is a team, or maybe even one point person for your family. So they can call in and say, okay, mom needs care now. I think she triggers her policy. I think she meets the definition of the policy, 2 out of 6 activities of daily living or cognitive impairment, and her expected need of care is more than 90 days. Now what? Okay. The care coordinators will help to put together a plan of care. What does that look like? The care coordinators will help to recommend even home care facilities, home care agencies, facilities, to be able to be an advocate and a helper to your loved ones in that time of need. And I don't think this can be emphasized enough. This is one of my favorite features about long-term care insurance is the care coordination factor. You also have potentially caregiver training. So if you do have a loved one providing care part-time, informally, they can help train those caregivers on how to properly move you, how to properly, help you transfer to and from places. Maybe even how to safely get in and out of the shower or the tub, those types of things. So, really important caregiver training. There's respite care. Again, if you have a part time, informal caregiver, they need breaks. That respite care can provide professional care so that caregiver can go take a break. Paid care can be brought in. That's really what long-term care insurance is and what it provides. The importance of assessing needs. Again, this is going to go back to your family and your finances. Who's in your family? Spouse, kids. What do your finances look like? What's your income? What kind of assets do you have? What are your investments like? My goal, again, is to be able to come up with a plan to be meaningful and affordable. So I want to know, what is your income? What kind of investments do you have? Do you have equity in your home? Do you have permanent life insurance that you don't want or need anymore? Do you have qualified retirement dollars in a 401k, IRA? What do your finances look like as a whole? Because I want to fund your policy in the most efficient way possible. So that's really important as far as the assessing, as well as where do you plan to retire? Cost of care in Columbus, Ohio, where I am, is way different from San Francisco, right? So where you plan to retire and be for the rest of your life matters of how much care costs. So we want to come up with a figure of, okay, if we get a policy that has $4,000 a month of coverage for 3 years, we have 3% inflation protection, so that policy is going to grow over time. We have a 90-day elimination period. These are all things that we're going to consider in that planning process when I'm assessing your needs. Now, what do you need to do financially? When you work with a long-term care insurance specialist, it's being open and this is what I have, so that again, I can help advise this is going to be the most meaningful and affordable way to fund a policy. There are really 4 main things when it comes to a long-term care insurance policy. Okay. The first thing is your benefit amount. This is going to be a daily or monthly benefit. So this is how much you have per day or per month to pay for care. It might be $200 per day. It might be $3,000, $4,000 per day. But again, this amount is really going to be probably from $1,500 per month all the way up to $15,000. There's a big range of how much you can actually get a policy for. So that's benefit amount. The second component to a policy is the benefit period. How long do you want benefits to last? They could last 2 years. They could last all the way up to your lifetime. So you had unlimited benefits. Again, big range there. And there's a price, there's a premium for that, but there's a big range. The third component is inflation protection. Really important, especially if you're younger, okay? If you're under 70, looking at inflation protection is important. What this is going to do is this is going to allow your policy to grow over time. Typically, we see the most common way for policies to grow is a 3% compound inflation protection rider. So every year, your policy, your monthly benefit, and your total pool of money is going to grow by this amount, okay? And so that, today you might have a $3,000 monthly benefit, but in 20 years, it's going to be a lot more because it's growing over time. So that's the third component. The fourth component is the elimination period. All policies are going to have what's called an elimination period. This is your waiting period. This is the amount of time that you are self-funding your care costs before benefits begin. Pretty standard is 90 days. Okay. That could be 90-day at home. That could be 90-day facility. It could be 0-day at home in a 90-day facility. Really depends on the policy. Sometimes you can modify that and pay a little more for a shorter elimination period. Sometimes it's just standard and they just say, this is what we do. It's 0-day home, it's 90-day facility, or it's 90-day for both, or 0-day for both. Just depends on the carrier, on the insurance company, and on the policy. But those are the four main components of a policy. And to give you an example, I think this is important to kind of flesh this out, Todd. If I have a couple that is age 55, and for me, this is probably average age for my clients. Most of my clients are in their 50s when they're planning. So if we have a couple age 55, live in Ohio, our average health, and we're just looking for a modest policy. We're not looking for a huge, robust policy. We're looking for a pretty modest policy. $3,000 monthly benefit, okay, for 3 years. That's your benefit period with 3% inflation protection compound that's going to grow every year for 3 years and a 90-day elimination period. We also are going to add what they call a shared care rider. This is going to allow spouses to actually share benefits. So each spouse has their own bucket of money, their own pool of money. If they use all of their bucket and need more care, they can then dip into their spouse's bucket of money and access some of their pool of money, okay? So that is something to consider if you are a couple. Being able to have some type of shared care or joint coverage is definitely a good idea to look at. If I've got a couple that's looking at these things, their total monthly premium would be $338 per month, okay? The male's premium would be about $126. The females would be about $212, okay? Women are going to pay more, always. Same age, we're always going to pay more because we go on claim more often and are on claim longer than men, typically, okay, statistically. So the insurance companies charge for that. So for $338, you've got a couple that are day one, they have a policy at $3,000 per month. It's going to grow over time. In 25 years, that couple their each pool of money will be over $9,500 each monthly benefit, okay? And their total pool of money each is over $219,000, okay? And again, they can access their spouses if they need it. So that's the leverage of insurance. And again, that's for $338 per month, okay? To me, that's pretty meaningful and pretty affordable. Now, some people might not be able to afford that, and they might not be able to do a policy like that. But for that amount, you're getting a good amount of coverage with growth in the policy.
That's great. That's amazing information. So important. And that example was perfect. It just crystallized what you've been talking about.
Mhm.
What happens with folks who already have a long-term care insurance policy if they come to you or folks like you? What can you do?
Yeah. So if you already have a policy, or maybe your parents have a policy and you think, gosh, they've got this great policy and I think they need care. Can they use their policy? Well, the number one thing is you want to review the policy. Okay. Those are the four things you want to look at: monthly benefit or daily benefit, benefit period. Do they have inflation protection? And what's the elimination period? How long do they have to self-fund their care? If the agent that sold that policy to you or to your parents or to a loved one is still around, contact them. Okay. That's their job. They've been paid not only to sell you that policy, but hopefully to service that policy if they're still around. If they're not, contact the insurance company and say, I have some questions to follow up with this. Can you clarify, what does this mean? Where are we at right now with their daily monthly benefit? How much is that today? What are the triggers? If it's a tax qualified long-term care insurance policy, those triggers are going to be, in order to receive benefits, you need help with 2 out of 6 activities of daily living, or a cognitive impairment and needs supervision. And your expected need of care is more than 90 days. Now, if they bought their policy 20, 30 years ago, it may not be those exact words. So you're going to want to ask, what are the triggers? How do I start a claim? How do I access and use benefits? You want to make sure you know how those benefits are paid out. Is it a reimbursement policy where you are paying for care upfront and the insurance company is reimbursing you? Or is it a cash policy, cash indemnity, where they're simply writing a check for your daily or monthly benefit and you can use that however you wish? So those are the important things to ask. Also, with that elimination period, you want to ask, is this a calendar day elimination period or is this a service day elimination period? If it's a calendar day service period, that is more desirable, because once you trigger your policy, every single calendar day that passes counts towards fulfilling your elimination period. Versus a service day elimination period, they're only looking at days that your loved one is receiving care. So if they're only receiving care 3 days a week, only those 3 days count towards your elimination period. So it could take longer to fulfill that elimination period if they're not receiving care every single day. If they have an older policy and they've had rate increases, which we've seen, it's common. And I can explain that a little bit. Basically, these older policies, people that have traditional policies, maybe it's an old Unum policy or Genworth or something like that, and the couple or the individual bought this policy years ago, these policies were mispriced. Okay. They were priced very, very low because they didn't have the data. These insurance companies, and it's not their fault, they didn't have the data to accurately price them. They didn't know how many people would hold on to their policy. They thought a lot more people would drop their policies. They didn't know how many people would go on claim. They didn't know for how long. Okay. This was, they were pricing their policies based on life insurance, based on disability. And those operate differently than long-term care insurance does. And they've realized that over time. But in order to be able to continue to service and to pay claims, insurance companies have had to increase prices on some of these premiums of these older policies. That's not a bad thing. It's really not, because these policyholders have really typically robust, meaningful policies, and they've gotten a heck of a deal for many years. So if you have loved ones that have received rate increases, as long as you can continue to pay those rate increases, do it. If you can't, then look to see what other options are available. Now, I will tell you, insurance companies are going to send a letter that says, there's been a rate increase. If you want to change coverage, here are maybe 3 options. Are those 3 options going to be in your best interest? Maybe not. They might be in the best interest of the insurance company. So you want to ask, what other options are available? If there's 5% compound inflation protection on that policy, maybe ask, if I reduce 5% to 3%, what are the premiums now? Because that's still that's still growth. There's still growth in there. Or maybe your parents are like already in their mid 80s and you're like, I'm not worried about this policy growing anymore. What if we just take inflation protection off completely? What would our premiums be? Or if they had lifetime benefits, What if we reduce that to like a 6-year benefit period? How much are premiums? So there are different ways. If they can't continue to pay those rate increases, there are ways to reduce that coverage, but still maintain coverage. So I would say that's important to look at. But call, ask the agent or ask the company that you have that policy is with to ask these important questions to be able to find out what makes the most sense for you.
That's been great. Thanks so much. We've been going through so much today, and I really appreciate it. And the audience, I'm sure, appreciates it. There's a lot to digest, and I'm sure there's a lot of questions, and I know they can reach out to you for further questions. And what I want to get into here in the remaining few moments that we have left is, so what happens when an individual or family can't afford the care? What alternatives are there?
Sure. Well, if they can't afford long-term care insurance, in providing home care, if that's too expensive, there's some things to consider. Usually the default is family, your informal caregivers, right? Maybe that's the spouse, an adult family member. You could also consider, possibly if you own a home, renting out a room of your house for a roommate to be able to get some extra income, to be able to help pay for care. If you also own your home, considering a reverse mortgage. Reverse mortgages have changed a lot, especially over the last, I'd say 5-10 years. Not something that I do, but I've been educated a lot in this in the last couple of years of how they've changed. And they really are a safe way to be able to access the equity in your home. If people have a good majority of their wealth in their home, that's something to consider. I don't think that that's something that you need to just say, oh, no, that's scary. I've heard horror stories about reverse mortgages. Do your research. Find a reputable reverse mortgage lender. I'm happy to offer some referrals. People want to ask me outside, happy to offer referrals. But something to consider, because most Americans have wealth tied up in their home. That's where the majority of their wealth really is. So that's not something to really put aside. I think that's something to consider. And then, of course, Medicaid. I mean, many families end up having to go on Medicaid because they have used all their resources. They have spent down their assets. They have little income. And so they have to rely on Medicaid. So, if you have to go on Medicaid, that's not ideal. You're not staying in control of your care options. You're not able to choose exactly where you want to receive care. But at the end of the day, if that's your last resort, if that's your only option, then that's your option. But, again, having the conversations with your family is really important. And I think the main takeaway is everyone needs a plan for extended care. No retirement plan is complete without a plan for long-term care. We don't want to be in that crisis mode. So have these conversations, do some planning ahead of time. If you have to spend down to meet Medicaid's requirements, work with a qualified attorney that specialize in Medicaid.
So one further point on that is, for folks who are watching this, and if they've gotten to the end of this and they're looking through, or they've been watching the whole thing, okay, wait, this doesn't apply to me, this doesn't apply to me, this doesn't apply to me. I just don't have the wherewithal or the funds. I want to make sure that these folks understand that they have the resources, as you were talking. Number one, you look at family. Okay, what can family do to help? And then other things that I've often told people, and I would love to hear your thought on it, is look for community organizations that can potentially help you. It might not be the ideal way that you want, but it'll be help nonetheless.
That's where it's important to look, like those resources I shared earlier, AAA, local long-term care ombudsman, those types of places. Maybe even your own, like if you belong to a church or some other community like that, maybe they even have resources, even if it's meals, Meals on Wheels, those types of things, to be able to help a little bit in that process.
Absolutely. There are different organizations, again, whether civic or religious based, that you can tap into and look into. I know there's Catholic Family Services, there's Jewish Family Services, and other family services that you can look into, and you may be surprised. They may have some programs that can help you. And if not, often they're a great resource to help you understand where you can look to help. And they
Right.
love helping. That's the essence of their organization.
Yes, absolutely. Yeah.
Yeah. Well, that brings us to the end of an amazing session. I'm thrilled again. Thanks so much for spending this time. The audience has a lot to digest. I have a lot to digest, even though I know a lot of this. I'm always learning, and hopefully the audience is always learning too. And again, for folks who are watching this, you can certainly contact Kelly, and there'll be information that when I go and post this about how you can reach Kelly. Or if you have somebody that you know locally, the most important thing is to look to folks to try and understand and get this moving along.
That's right. Reach out, get help. Don't be afraid to ask questions. I do work nationwide also. So, if you're in, Minnesota and think, oh, well, Kelly's in Ohio. No, I work nationwide too.
That's great. And so thanks again. Thanks so much for your time. And I wish you and your family a wonderful holiday season. Happy, healthy New Year. And
You too,
all
Todd.
the best.
Thank you. Take care.
Take care. Bye-bye. The primary purpose of the podcast is to educate. While guests are invited to listen, listeners acknowledge that they are not being provided professional advice from the podcast or any guests. One Day, One Week and its sponsor, 17 Commerce LLC, expressly disclaim any and all liability or responsibility for any direct, indirect, incidental, special, consequential, or other damages arising out of any individual's use of, reference to, reliance on, or inability to use the podcast episodes or the information presented in the episodes.